Welcome back to Classic Books Deep Dive, the show where we unearth the hidden gems in those books everybody's heard of, but nobody's really, dug into. Today, we're diving into one of those books that everyone says you just have to read.
Oh, I know the one.
Intelligent Investor.
Yeah, Benjamin Graham.
Yeah.
Like the OG of value investing.
And we've got, a pretty special edition here.
Oh, yeah.
It's got the preface by Warren Buffett.
Oh, wow. The Oracle of Omaha himself.
Who says it's the best book on investing ever written.
No pressure or anything for us then.
Well, that's quite the endorsement. I have to admit, I'm a little intimidated. Investing can seem, so complex.
Oh, absolutely. But that's actually what's so cool about this book, I think. Graham really, he sets out to demystify it all.
Oh, well.
To give you a framework for making decisions that are based on logic, research, all that good stuff.
Oh.
Instead of
just your gut feeling.
Yeah, or FOMO,
Yeah.
fear of missing out.
Oh, yeah, for sure, especially with money. I feel like emotions run especially high there.
Oh, 100%. And that's why Graham's work is still so relevant, I think. I mean, this book was first published in 1949.
Really? Wow.
But human nature, when it comes to money, well, it hasn't changed that much.
Yeah, that's a good point. So what are some of the big ideas that he's laying out?
So one of the most fundamental things is this idea that there's a really big difference between investing and speculating.
Oh, okay.
And he has this very specific definition of what investing actually is. He says it's an operation that's based on thorough analysis, and it promises two things.
Okay.
Safety of principal and an adequate return.
Okay, so break that down for me. What does safety of principal mean?
So basically it means protecting your initial investment, making sure you don't lose money.
Got it.
And then adequate return. That just means, making a reasonable profit over time.
So not about getting rich quick.
No, definitely not. And not about taking huge risks. Graham's all about being disciplined, thinking long term.
I like it.
He really warns against following the crowd or relying on luck. Basically anything that doesn't involve really carefully researching and analyzing the situation, that's speculation, not investing.
So buying into the latest hot stock tip without actually understanding what the company does or its financials.
Exactly. He actually gives this really interesting example of the airlines in the 1960s.
Oh.
Where even the supposed experts got caught up in the hype and made some pretty bad decisions.
Yeah, you can see how that would happen.
And I think it's so interesting how these historical examples can still teach us so much about human behavior and how markets work.
Definitely timeless lessons, it seems.
Exactly. Graham's principles, they really are timeless because they're based on this deep understanding of both human psychology and the fundamental principles of finance.
Makes sense. Now, one thing that I always worry about as an investor is inflation. How does Graham address that?
So he acknowledges that inflation is a really big factor for sure, but he argues that over the long term, common stocks have historically offered some protection against it.
Okay.
Because stocks, they represent ownership in actual businesses, right?
Right.
And businesses can often raise prices to kind of keep up with inflation.
That's true. Although, haven't we been in a period of relatively low inflation for a while now?
That's true, but that's where the updated commentary by Jason Zweig comes in.
Okay.
He reminds us that even these low levels of inflation, they can still eat away at your wealth over time, little by little.
Yeah, that makes sense.
He points out that during those periods of really high inflation, like back in the 1970s, even what seemed like a really good return on an investment could actually turn into a loss after you factor in inflation.
Oof, that's scary to think about.
It is, and it's a good reminder that we can't get complacent. Right?
So what does he recommend? How do we protect ourselves?
So Zweig, he really emphasizes diversification, following, Graham's ideas, not putting all your eggs in one basket. He suggests having a mix of stocks and bonds in your portfolio.
Okay.
Bonds tend to be less volatile than stocks, so they can offer kind of a cushion when the market's doing crazy things.
That makes sense.
And he also highlights the strategy called dollar cost averaging.
Dollar cost averaging, okay. What's that?
So it means investing a set amount of money at regular intervals no matter what the market is doing.
Okay.
That way you end up buying more shares when prices are low and fewer when they're high. and it all averages out over time.
Oh, that's smart.
Yeah. So it's a way to kind of take the emotion out of it and just keep investing consistently.
I could see how that would help. So it's all about mitigating the risk and just, building wealth steadily.
Exactly. Graham, he's all about slow and steady, not about those get-rich-quick schemes or trying to, perfectly time the market or anything like that.
No crystal balls here?
Nope, no crystal balls.
Yeah. So you mentioned earlier that Graham, he talks about different types of investors.
He does. He talks about the defensive investor and the enterprising investor.
I'm guessing those aren't just like any random terms he came up with?
No, they're very specific within his framework.
Okay.
So the defensive investor is someone who really prioritizes safety and simplicity. They're looking for investments that are, relatively low risk, and they're happy with kind of a moderate return.
Okay, that makes sense. And what about the enterprising investor? What are they like?
They're willing to put in more time, do more research, and they might be okay with a little bit more risk too.
Okay.
But even for them, Graham really stresses that it's still all about thorough analysis and avoiding speculation.
So no jumping on bandwagons, even for the risk takers.
Nope. Not in Graham's world.
Oh.
He believed that good investment decisions should always be guided by those sound principles, no matter what your risk tolerance or your investing style.
Okay, I can see that. Now, I noticed that Graham, he uses a lot of historical data when he's making his arguments.
He does. He looks at market trends going all the way back to the early 1900s.
Wow.
And he shows that over the long term, the stock market tends to go up even after those big crashes and bear markets.
Well, being patient is really key, huh?
Oh, absolutely. That's really the heart of Graham's philosophy, I think. Invest for the long haul and don't freak out over those inevitable ups and downs.
Makes sense.
He even has this whole chapter about Mr. Market, which is one of his most famous ideas. I think we should definitely talk more about that next time.
That sounds pretty intriguing. Okay, so let's pick up there next time when we dive back into the intelligent investor. So last time we were talking about this idea of Mr. Market.
Oh, right, Mr. Market.
What exactly is that?
So it's this really famous analogy that Graham uses. He wants you to picture the market as this moody guy named, Mr. Market, who shows up at your door every day wanting to either buy your stocks or sell you his.
And he's kind of unpredictable, I'm guessing?
Oh, totally. Some days he's euphoric, offering these crazy high prices for your shares.
Yeah.
Other days, he's all doom and gloom.
Mm.
Wants to sell his stocks for practically nothing.
So it's like an emotional roller coaster dealing with this guy.
That's exactly Graham's point. He's trying to show us how the market is often driven by these short-term feelings, emotions, not by rational analysis or the actual worth of a business.
So how are we supposed to deal with this Mr. Market and his mood swings?
The key is to not take him too seriously.
Wow.
Realize that his moods, they're his problem, not yours. You don't have to buy or sell just because he's feeling a certain way that day.
Makes sense.
You have the power to choose.
Right.
You can buy from him when he's all pessimistic,
When he's down in the dumps.
Yeah, and sell to him when he's being, way too optimistic.
So it's all about capitalizing on those moments where the prices don't really reflect the true value.
Exactly. The intelligent investor, according to Graham, they're patient, they're disciplined.
Mm-hmm.
They wait for those opportunities to buy low and sell high. But remember, all of this is based on doing your research first.
Right.
You got to figure out what a company is actually worth, its intrinsic value, before you can decide if Mr. Market is giving you a good deal or not.
That's a good point, yeah. So speaking of good deals, I want to talk about Graham's specific portfolio recommendations.
Oh yeah, let's get into that.
You mentioned that they're different depending on whether you're a defensive investor or an enterprising investor, right?
Mm-hmm.
So let's start with the defensive investor, the person who's prioritizing safety and simplicity. What kind of portfolio does Graham suggest for someone like that?
So he recommends this classic balanced approach, mix of stocks and bonds.
Right.
He suggests aiming for somewhere between 25% to 75% in stocks, and then the rest in bonds.
So even a defensive investor, they still need to have some exposure to the stock market.
Yeah, that's right. But they've got that nice cushion of bonds to kind of provide stability.
Right, to balance things out.
Exactly, reduce the risk.
Yeah.
Because bonds, they generally don't fluctuate as much as stocks do.
Okay, that makes sense. Now, what about specific types of bonds? Does he recommend any particular ones?
He does. He talks about U.S. savings bonds, which are considered like super safe,
Okay.
but they might not have the highest returns. And then other U.S. government bonds also tend to be pretty low risk.
Okay.
He mentions state and municipal bonds too, which can be good because they can have tax advantages,
Mm-hmm.
and even corporate bonds, but he's a little more cautious about those because they depend on the financial health of the company that issued them.
So there's a bit more risk there.
A bit more, yeah. So basically, the defensive investor should stick with high quality bonds from issuers that are, pretty reliable.
Yep.
Safety and a decent return are the key things to think about. He warns against like reaching for really high yield
Okay.
by investing in bonds that aren't as high quality. Because remember, for the defensive investor, the top priority is protecting that initial investment.
Not losing money.
Exactly.
Okay, that makes sense. Now, what about the stock portion of the portfolio? What kind of stocks does he recommend for the defensive investor?
He says to stick with large, well-established companies.
Okay.
Ones that have a long history of stable earnings and dividend payments.
Mhm.
Think like blue chip stocks, the kind of companies that everyone knows
Okay.
and that have been around for a while and that have, a track record of weathering those economic storms.
So not those like flashy tech startups that are all potential, but maybe not a lot of profit yet.
Right. He's advocating for proven businesses, ones that have a solid history of success.
Okay.
Because those companies, they tend to be more resilient when the market takes a dip.
Yeah.
And they offer a greater margin of safety for the defensive investor.
Yeah. What about growth stocks? Are those totally off limits?
He's pretty cautious about them,
Go ahead.
especially the ones that are trading at really high prices compared to their earnings. He's basically warning us not to get caught up in the hype, the latest trends.
Right.
Especially if those trends haven't actually translated into real profits yet.
So it's about being like discerning.
Yes. And not just blindly following what everyone else is doing.
Exactly. So for the defensive investor, it seems like Graham's really advocating for a simple, straightforward approach.
He is.
Focus on those established, profitable companies
Uh-huh.
that have that history of paying dividends.
Yep.
And just avoid anything that feels like a gamble.
Exactly.
Okay, that sounds like a pretty solid strategy for someone who's kind of new to investing or who really wants to prioritize safety and simplicity.
I think so.
Now, what about the more adventurous investor, the enterprising investor? What does Graham have to say to them?
So for them, he's got a more active approach in mind.
Okay.
It involves more research and a bigger focus on finding those undervalued individual stocks.
Right.
And this is where that concept of intrinsic value
Right.
becomes like even more important.
Because they're trying to find those hidden gems, right? Those
Yeah.
companies that the market has mispriced.
Exactly.
And they're trading for less than they're actually worth.
That's the holy grail for the enterprising investor.
But even for them, it's not about speculation, right?
No.
It's still about doing the research.
Oh, absolutely. Graham, he gives us a bunch of techniques for identifying these bargain issues, as he calls them.
Hmm.
And they all involve really digging into a company's financials.
So what are some of those techniques? Like, what should an enterprising investor be looking for when they're trying to figure out a company's its intrinsic value?
So he talks about things like the price to earnings ratio,
Right.
which compares the stock price to the earnings per share. He also looks at things like the company's financial strength,
Okay.
their debt levels, their cash flow, their dividend history.
So it's about going beyond just the surface level stuff,
Yeah.
right? Really understanding how a business is doing, not just how the market is perceiving it at this exact moment.
Exactly. And this is where the enterprising investor, they really got to be willing to put in the time to research those individual companies
Mm-hmm.
and understand their businesses like inside and out. It's not a passive thing at all.
It's a lot of work.
It is. It takes dedication and a willingness to keep learning.
And probably some comfort with like financial statements, like understanding accounting and all that.
Oh, for sure. But Graham, he emphasizes that this This shouldn't be based on guesswork or just like your gut feeling.
Right.
It has to be grounded in solid analysis
Okay.
and a clear understanding of the fundamentals of the business. He's not talking about like day trading or chasing after those meme stocks. This is about that long-term value investing, finding those companies that are built to last.
Okay.
And that are going to grow their earnings over time.
So even though the enterprising investor, they're taking this more active approach, it's still about that long game, right?
It is. It all comes back to that idea of building wealth slowly and steadily.
Not those quick wins.
Not the quick wins. And this brings us back to one of Graham's like big themes, which is the importance of controlling your emotions when you're investing.
Oh.
He understood that human psychology, it plays a huge role in our investment decisions and often not in a good way.
Right. We get swept up in the excitement, the fear.
Exactly. We get caught up in the excitement when the market's going up, and then we panic when it drops.
And we end up making bad decisions.
Yeah, we buy high and then sell low, which is like the opposite of what you want to do.
Exactly. So he's basically saying, like, don't let your emotions rule your investing.
Exactly. And remember Mr. Market, that moody guy we were talking about earlier.
Right.
He represents that emotional force, you know?
Yeah.
The intelligent investor, they recognize that he's often irrational,
Right.
and they don't let his mood swings like dictate their actions.
So it's all about discipline, not getting swept up in the fear and the greed.
That's it.
That can really drive those market swings.
Exactly. And I think this is where Jason Zweig's commentary is really helpful, you know, in the updated edition.
Okay.
He brings Graham's principles into the 21st century.
Okay.
He talks about things like investing in the age of the internet,
Oh, wow.
the rise of index funds, and all the challenges that come with, you know, behavioral finance, the psychology of investing.
So how do Graham's principles hold up in today's world? Like,
Yeah.
Things have changed so much since 1949.
They have, but it's kind of amazing how relevant his ideas still are.
Yeah.
Zweig does a really good job of showing how those principles can be used to navigate the markets today.
Okay, so like, what are some examples?
Well, think about the rise of index funds. They've become super popular for good reason.
Yeah.
They offer a way to invest in a whole bunch of different stocks, you know, kind of a basket of stocks.
Right.
At a really low cost, which is great for a lot of investors.
But how do they fit into this whole value investing philosophy?
So Zweig, he points out that even though index funds are diversified, it's still important to understand what you're actually investing in. You need to know what's in that index,
Right.
how they choose the stocks, what companies are actually in there.
So you're not just blindly throwing money at an index fund.
Exactly. You still have to do your research, understand what you're buying.
Okay, that makes sense. Now, what about all the new tools and technologies that are available now? Do those change things?
They can definitely make the research process easier.
Okay.
And they give us access to like way more information than ever before. We've got, you know, online brokerages, financial news websites, all these data analysis tools. There's even like artificial intelligence algorithms that can help us analyze stocks.
Wow. It's a lot.
It is.
Yeah.
But it's important to remember that these tools, they're just that tools.
Okay.
They can't replace critical thinking and good judgment. You still have to understand those investment principles.
So we still have to be able to, like, you know, sort through all that data and figure out what's actually important.
Yes. Separate the signal from the noise, as they say.
Exactly.
And make decisions based on your analysis, not just on what some algorithm is telling you to do.
Right. And when you think about things like high frequency trading algorithms.
Oh, yeah.
And just how complex the markets have become, it seems like. Graham's advice to avoid speculation and focus on long-term value, that's more important than ever.
It is. It's easy to get caught up in all the frenzy, especially with all the news and information flying at us all the time. Sticking to that disciplined approach, doing your research, remembering that the market, it often does crazy things in the short term. Those are really key takeaways, and they're just as true today as they were back then.
It's kind of amazing how a book written so long ago can still be so relevant.
I know.
To the challenges that we face as investors today.
It really speaks to the power of his insights, I think, both into the financial markets, but also into into human nature.
Yeah, he really understood people.
He did. His work it's a great foundation for anyone who's looking to build wealth in a smart way.
Okay.
And to navigate this crazy world of investing.
Well said. This has been a really, really enlightening deep dive
Fun.
into The Intelligent Investor.
Yeah. I always enjoy revisiting this book. There's always something new to learn.
Yeah. I have to admit, all this talk about value investing, it's got me thinking
Oh yeah.
about
what if we applied these principles to other areas, like real estate, for example?
Ooh, interesting.
Could we use his ideas about thorough analysis, and understanding intrinsic value, and ignoring the hype to find those hidden gems in the real estate market?
I like that. I think there's definitely potential there. It's like
Yeah.
it's like he's saying, look beyond the shiny surface and focus on the fundamentals,
Yeah.
right? The underlying value.
Exactly. Whether it's a stock or a piece of property, I think that could apply to a lot of things, actually.
Definitely food for thought.
Yeah, but that's a deep dive for another day.
Another day for sure. So thanks again for joining me.
Of course, always a pleasure.
And for our listeners, if you're interested in learning more about Graham's ideas, definitely check out The Intelligent Investor.
Great book.
It's a classic for a reason. So we've talked about a lot, like everything from, investment versus speculation to like the different types of investors.
Yeah.
And how important it is to like keep your emotions in check when you're dealing with the market.
Yeah, all that good stuff.
But if you had to like sum up Graham's philosophy
Okay.
into like one key takeaway,
No, that's tough.
what would it be?
I think it's this, and it's one of his most famous quotes. The intelligent investor is a realist who sells to optimists and buys from pessimists.
Ooh, that's good.
Right.
That's really good.
It's so simple, but it really does capture like the essence of his whole approach.
Yeah.
He's basically telling us to be contrarian,
To think for ourselves.
Yeah, to think for ourselves and not just get like swept up in whatever everyone else is feeling.
Like to be the voice of reason when everyone else is kind of losing their minds.
Exactly, and to base our decisions on facts, on analysis, not on hopes and dreams or fears.
Right. And remembering that Mr. Market is always out there.
Oh yeah,
Trying to mess with us.
he's always lurking.
Yeah. With his crazy offers.
Exactly, but the intelligent investor, they see through that. They make their decisions based on logic and on a real understanding of what things are worth.
So it's really about taking that long-term perspective.
It is.
Knowing that the market is going to go up and down.
It will always.
And not letting that throw you off course.
Exactly.
It's about building wealth slowly and steadily.
Slow and steady wins the race, right?
Now, I do have to ask, like, what about all the changes that have happened in the investing landscape since Graham's time?
Oh yeah, that's a good point.
Like index funds, ETFs, all the new technology, all the algorithms, all that stuff.
It's a lot.
It seems like investing has gotten so much more complex since 1949.
It definitely has in a lot of ways. But what's funny? Those core principles that Graham laid out, they're still really relevant.
Okay, so how do we apply them in today's market?
Well, the biggest thing is that emphasis on research and analysis.
Okay.
Really understanding the fundamentals of a company or an investment, that's still crucial. No matter what you're investing in, whether it's in individual stocks or index funds or ETFs, you got to know what you're buying.
So no more just, throwing money at the latest hot stock.
You got to do your homework.
Especially if it's like some tech company that everyone's talking about, but they don't even have like any profits yet.
Right. Buzz doesn't equal value.
And what about all the new tools, all the new technology?
Yeah, that's interesting.
Does that change things?
I mean, they can be really helpful.
Yeah.
They can speed up that research process, give you access to like a ton of information.
Right.
But it's so important to remember those tools, they're just that, tools.
Okay.
They can't replace your own thinking.
Right. You still have to use your brain.
You do. You have to be able to filter out all the noise, figure out what's actually important, make good decisions.
Not just blindly following what some algorithm tells you to do.
Exactly. And when you think about things like high frequency trading algorithms and just like how crazy the markets can be.
Yeah, it's It's intense out there.
It is. Graham's advice to avoid speculation and to really focus on the long term.
Mm-hmm.
That's more important now than ever, I think.
It's about not getting caught up in all the hype and the craziness.
It is. It's about being disciplined,
Okay.
doing your research, and remembering that the market is often irrational,
Right.
especially in the short term.
This has been really fascinating.
It's a great book.
I feel like I've learned so much
Too.
about investing from this deep dive into The Intelligent Investor.
It's a classic for a reason.
Yeah, it really is. It's amazing how relevant it still is.
I know. It's a testament to Graham's genius, I think.
So for our listeners out there, if you're looking for a book that can like really change the way you think about money and investing, this is the one.
Couldn't agree more.
Definitely check out The Intelligent Investor.
It's worth it.
It's a classic for a reason.
It is.
Well, thanks again for joining me.
Oh, it's always fun. And to all our listeners out there, thanks for tuning in to Classic Books Deep Dive.